All right, good morning. Happy Thursday. Today is Thursday, March 19th, 2026. Welcome to this month's Capital Markets Update and Outlook call. We are live on our website as well as all of our social media pages. If you are here with us live or if you are watching in the recording later, thank you for taking some time out of your busy schedule to be here with us today. If you are joining us for the very first time, my name is Eric Hagan. I am a financial advisor. I'm also president of Capital Consulting Group, or CCG. CCG consists of myself, our chief investment officer consultant, Tom Fox, who we will hear from in just a minute or two. Financial advisors, Dan Oshman, Rana Grant, and Jeff Halverson, and our client support team. We've got Josh Denny, Karen Miller, and Ann Colian. Together, our goal is to help individual investors make their next financial decision, and the one after that, a good one. One of the ways that we deliver on that commitment is through today's monthly update. Today's an opportunity for each of you to kind of look over our shoulder, get a balanced analysis of what we see out there, and ultimately to be a more informed investor. We do this in two ways. First, we can help you see your entire financial situation, both today as well as every year into the future through our personal wealth planning services. If you'd like to learn more after today's message, I invite you to head over to clearfinancialfuture.com. There's a very nice 2-minute video that explains what that looks like. And then secondly, we help our clients get invested right. Being invested right is distinct to every account that we manage, and SmartMix is our process, our personalized portfolio solution. Whether you have $25,000 or $25 million, SmartMix is our process for helping you get and stay invested right. And again, after today's message, if you'd like to learn more about that process, you can head over to smartmixportfolios.com. Today, we're going to hear from Tom Fox. Tom will review the positives in the markets, the headwinds, and give us his outlook for the rest of the year. Ultimately, again, this is your opportunity to kind of look over our shoulder, get an idea of what we're seeing in the markets and the economy and what we're watching for. So I encourage you, if you have any questions, put them in the comments section below wherever you're watching. You can also send me an email. I'll be watching my emails. You can also now text us at our office number, and I would love to field those questions. There will be Q&A time at the end, so send a question anytime you'd like throughout the message here, and I'll bring that to Tom. I'll bring those questions to Tom at the end of his message. Tom spends all of his time more behind the scenes doing market research, due diligence, running different analyses, and really focusing his attention on the economy and the markets. He has almost 40 years experience building investment strategies. He has an impressive long resume, as you can see on the screen. And as always, I'm very excited to have him here with us today. So again, at the end of today's message, we will have Q&A. Whether you're watching with us live today or if you're watching in the recording, drop in your questions, email us, text us, whatever you'd like. I do get all of those. We would love the opportunity to circle back with you. So with that, I'll bring our theme up. I'll bring Tom on. Good morning, Tom.
Good morning, Eric.
Thank you for being here. We're looking forward to your message.
Yes, looking forward to deliver that message in very volatile times.
Isn't that an understatement?
Yes.
I think a lot of us are patiently waiting for your analysis of everything that's going on, because there is a lot going on right now.
There is. In fact, 2 of our wild card events have taken place.
That's right.
And we're navigating through that, and we're going to go through and give our thoughts on where things may end up going. But we're excited about volatility. I think if you remember, one of our calls, number 1 call, was for extreme volatility in 26, and that's exactly what we are seeing. So things have changed. I kind of relate that to AI. AI is changing everything, and we're at the very beginning innings of seeing that unfold, which will have all kinds of impact on businesses, employment, and many other things as we go down the road. Okay, our outlook, as you know, Eric, we always like to start off with the risks.
Get the bad news out of the way first, right?
Yeah, we get the bad news so we can start to head towards some potentially good news. But obviously, the geopolitical risk is elevated. The conflict and definitely the Strait of Hormuz disruption has been creating lots of volatility, and we'll talk about what our view is on that. And of course, when you have an oil shock, which was one of our wild cards that we had in our data, creates potential inflation risk. And the Fed just met; they held interest rates, and you can see that that was one of the subjects of what the impact will be. But higher energy prices could push up inflation in the near term, and we'll talk more about that. And of course, the Fed easing delayed. Initially, we were expecting 2 cuts this year. Now that is no longer the case for the markets. We do think down the road they'll start cutting again, but it all depends on how fast this war gets executed. So we'll see. But higher for longer puts a strain, because obviously if rates are going down, stocks do well, and it's great for stock pricing. But it's on delay right now, so that's on hold. And of course, we've got this one. This is many of the companies, top 10 stocks, heavy reliance on AI names. If anything begins to go undo in the higher, bigger names in the market, and the S&P 500, you can see that impact the S&P 500 because it's a bigger weighting. So there's a lot of concentration risk, more than we've ever seen. And that's always a risk out there if one thing goes wrong with maybe a particular AI stock. Now we have consumer sensitivity to gasoline. We've seen the price pump going up. I think we're around $3.60 some cents in Minnesota. That's 20 cents lower nationally than national. And so, but that impacts, it's like a tax on the consumer. When you get the brakes, when the gasoline goes down, it's like a tax credit for people. But now it's going in the other way. And how will this impact consumers, which is 70% of the GDP? Of course, we have global weakness, especially in Europe and parts of Asia. We'll look at their exposure to energy shocks, and they could end up being slower growth. We've already seen the outperformance of the international stocks begin to go the other way. Now U.S. is on a relative basis outperforming stocks outside the U.S. And bond yields have been creeping up. 430 this morning, Eric. And if it breaks 430, we could see it go to 450 on the 10-year. And that would push downward pressure on pricing of bonds. That is one of the reasons why we have I think we're at 60% of our fixed alt is in alternatives that aren't dependent upon interest rate movements being favorable. So we're actually doing quite well relative to the aggregate. And then we have late cycle dynamics. Hey, we're in our 4th year of this bull market. Slower growth, tighter policy conditions, all kinds of different administration changes. All this puts pressure. Are we going to end up coming to the end of this bull market? And then we have consumer softening risk. Now, we haven't seen it, and we'll look at some charts on this, but consumers could begin to pull back if this oil pricing continues on the upswing. So there's potential for 10% correction. We actually put that in our forecast that we would see sometime in 26 a 10% correction. Now, we haven't even come near that, but it could happen. We forecasted it was a possibility, and then we'll get into we think where it ends at the end of the year. So they could see stocks begin to reprice around all this uncertainty that we're experiencing. But are there reasons to be in stocks? Yes, there are.
Give us some good news too, would you?
All right, now we're going to shift from the bad news, good news. Earnings growth remains strong. We've had stellar 15% expected and 26% year over year. That's a fundamental anchor for equities. What ultimately drives stock prices is earnings. And so far, now we'll see whether this is a temporary oil spike or how it will unfold into equity earnings in the future. But right now, it's solid. And we just had another solid quarter. And of course, if you look at the expectation for this year, the rest of the quarters, it looks very positive, double-digit growth. AI-driven investment cycle, and we're in the camp that we're in the very early innings of how AI will impact corporations, how they're going to end infrastructure. We got industrials, we're very early in it, and we're still very bullish on AI. Economic expansion continues. Growth is moderating, but remains. We don't see a slowdown to a recession. If we look at all the economic numbers, of course, the wild card is how long this war does last. But currently, the U.S. is in great shape. Now, they did lower the GDP from their estimates before, but it still is not anywhere near a slowdown in terms of heading towards a recession. But we will be monitoring that as we go forward. And then there's been some labor market stability, low unemployment, still 4.4. Historically, that's very low if you look on a historical basis. So limited layoffs. Now, this is going to ebb and flow, but we haven't seen the big AI replacement of employees yet. I think employees are needed to adapt to AI, but whether or not how much this will impact in the future, I think it will impact it more down the road. But currently, we don't see much impact from AI disrupting employment. Productivity tailwinds, rising productivity. This is only 2.8%, but we believe it's going to double. That productivity will actually double because of AI, offsetting wage pressures and margins. And this is all good for stocks. If stocks, again, can become more profitable, then they're going to go up in price and make a good long-term investment. And we also believe the current pullback we're experiencing is an opportunity. Market corrections within bull markets, which we still say we're in a bull market, historically provide attractive entry points. It's kind of counterintuitive. All your emotions say, no, I don't want to go in when things are looking bad, but it could be a very good time to actually increase or begin to enter equities as we go forward. Strong balance sheets, corporations, well-capitalized, high margins, pricing power, and this is, we expect even to get better with the AI phenomena. And then, of course, we got the one big, beautiful bill, which we're going to start to see all this money come back to consumers. We think it's going to be a great for the future, high margins and pricing power for companies. They get to write off things immediately, get tax credits for investments. The one big, beautiful bill is a very positive for the economy and thus the stock market. Now, here's an important one, Eric, is that markets anticipate, not react. Before the market, before the macro scene with all the Iran and war and oil prices changes, the market will move in advance. It smells it out, and it discounts the future. If we see any slowdown, for example, Iran's missiles and drones begin to fall off to nothing, you will see this market begin to move very quickly. And of course, the U.S. and Israel are working very much at doing that. And it all depends how long it takes. So we'll see, but the market discounts the future and will move in advance of we seeing it in the fundamentals. All right, here's title: Extreme Volatility, Oil Spikes, and the bigger picture. I should probably circle the bigger picture, but we got to stay on the bigger picture in the midst of this crisis that we're in right now. And bull markets often survive wars and prosper. You can see from the charts, you would be very well off if you bought in the invasion. And these are a number of wars and small wars that we've experienced over time and conflicts. And you can see that there's upside in most cases when you bottom out in the invasion and then it begins to move before things actually get settled out. So again, this is history. History tends to rhyme. And so we think it's a good time to maybe be buying in the current market. All right, market pullback found support. Now this is being tested again. I put these charts out and it changes, Eric, like in 2 days. But you can see the market was only down 4%. I think it's now 5% from its high, all-time high, and we're only down a little over 3% year to date in the S&P 500. That's remarkable based on what's going on. So you can see how resilient this market is, because we've had very little downside. And of course, on Monday, we had a recovered some, and it's kind of pulled back, come down again from there. It's going to be bouncing around until we see how long this war will go on, and we'll talk more about that. But I'm really impressed with its resilience.
It's been pretty incredible. Yeah.
Yep. And here's the drawdowns from the high. You can see this. We were down 60-40 portfolio, down 4.5. But the Russell 2 and the world, which was outperforming, now has turned down a little more. But you can see they're not even in correction territory, 10%. So we've been able somehow to maintain all these areas not dropping into correction. And that is astounding. You can see back in 25, when Trump came out with all the tariffs, how far the market went down. And this seemingly is a big event, but look at the impact has been very it's mitigated by other things. So we're impressed with the downside so far. Now we could see a 10% drop. We haven't seen it yet, but right now it's been holding up fairly well. Even today, with not any good news yet, the market's still only down 63 basis points. So we haven't seen the big drop. It could come, but right now we're seeing some resilience here in the stock market. Here's shifting leadership. As prior to the invasion, you saw equities were outperforming overseas, and the U.S. was only down 2%. Now that's reversed since the war, because we're going to see a chart that Asia and Europe are impacted more by the oil problems. So you can see that when this was taken, that snapshot, it was only down 7 in March. That's for March, with 70 basis points versus the other areas. So we believe there is going to be a shift back to the U.S. Early on in the year, it was international stocks were leading. Now we think it's going to be a shift back. And also we think it's going to come back to the tech and growth as we move forward. Now here's the VIX. It peaked out at 35. And let me look at it, what it is right now. The VIX is still holding in there. It's ticked up, but it's not off the chart where it was at 35, and it's pulled back. So what that tells you is that the volatility, which is a measure of risk, that the market sees risk out there, has been not at its peak. It's not. It came back to a below 25. When it drops below 25, typically that has ended up in strong stock market going forward. And prior to the crisis, this is a bullish signal. We saw that Mag 7 was the underperformer, but S&P 500 was down. But you can see the Russell 2. We started seeing not value stocks do well. We saw DM, developed markets and emerging markets do well prior. So that broadening out is typically, outside of tech, is usually a bullish signal. Now, we want to keep our eyes on the big picture, and I've circled there. Look at all the double digits expected growth. Eric, you can see where we're at, and you can see the fourth quarter was double digits, and we're expecting 15% in this next quarter for the first quarter of this year. So it's all in the teens. That is a good sign for stocks because stocks ultimately are driven by earnings. We think AI is a big part of this. We think a number of things are a big part of this. And we expect that to continue. Now, there could be a bump in the road if oil stays high, but it's still an unknown factor as we move forward. Another positive is normally February is a rough month, which we had, but March and April typically are strong. You can see the March and April on the left side, the average return by month, it's one of the highest. And you can see the percent of times positive. March and April are typically strong. So we have some good seasonality. I know Tom Lee, who I'm a fan of, was just recently saying he still thinks March could end up being a positive month for the stock market if we get this resolved within the next week or two. But yeah, seasonality, it's great, but it depends on where oil ultimately ends up. Here's another positive: technological progress, growth, productivity, and rising living standards. You can see the blue line is the GDP, and you can see the employment. You can see how GDP growth, gross domestic product in the US, is catching up with employment. You can see the earlier gaps back in time. Why? Because technology is changing many things. And we think eventually those lines will cross where we're getting more growth economically with less people. And that's where it's heading. And that AI is going to be a big part of that. But productivity growth and standard living is all increasing, and it has to do with technology. Here's another one. Now, this came out just prior to the March breakout of the war, but you can see that a lot of the countries, Japan, Eurozone, China, United Kingdom, and the US, were all going upward in expansion instead of heading towards contraction. Now, this oil wild card that's impacting everything currently, that's kind of thrown something into it, but we think we were in good footing prior to this, and we think if this is short-lived, we could end up continuing these expansions in different parts of the world. Are you frozen?
I think we froze there for a second. Give me a second here. Yeah, I think the PowerPoint froze up, so let's just give it a sec. Technical difficulties.
We've had a few of those.
Yeah, right. I may need to shut down PowerPoint and open it back up, but sometimes it'll come back on here.
There we go.
We're back.
You got to go.
You were right here.
Okay. Now, this is a chart I've shown a number of times, but this is the fourth year of recovery of a bull market after 3 strong years, which we've had. And it seems to be playing out. And history sometimes rhymes. It's not exact, but we could see this unfolding. If this Iran conflict gets resolved in a favorable way, we could see this market running back up to 7,300. And now this is the average of all the historical fourth years, but it does seem to play out. Now, this is one of Tom Lee's favorite charts, and this is what they expect will happen during this year. There's no guarantees that will happen, but we still are bullish for the year. But we could see a move higher, and then it kind of pulling back in that September, October, November period, September, October period, and then going back up and finishing the year strong. So this could end up being what unfolds, but it all depends on what happens with the Iran war. And so we'll see what happens here. So navigating geopolitical uncertainty and oil spikes. This is the Strait of Hormuz, which so much of the oil goes through, not for the US, but for the Asia, partly Europe, mostly Asia. And you can see the average for February prior to the war, and then now how many ships are going through the Strait of Hormuz. It could drop significantly. Just a few of them are going through. You can even say there was nothing there at one point. So this is what's got to be resolved, and resolved quickly, especially for Asia and Europe. But you can see the dramatic impact where a lot of this oil goes through, and other goods as well. We have not just general trade goes through. So there's a lot of things that go through the Strait of Hormuz. So this definitely is one thing that needs to get resolved, and resolved quickly. Despite that, we saw, in fact, the oil was just at $98, but remember, it reached 120. So this is interesting. It's pricing in oil for higher, but look at, it's not surging at its highs. That's a good sign that people are believing that this will get resolved sooner than later. And we are in that camp. We think it will be resolved, maybe weeks, but we think it will not be a long, protracted war. Okay, so here's an interesting. How about U.S.? Well, we've become net exporters, and if you can see the production has been going up. And you can see our production has now met our consumption from the United States. You can see that top circle. And you can see we used to, in 09, for example, and 08, we imported a lot of our energy. Now we're a net exporter. That's what the bottom line is showing, that we're a net exporter. I think the next chart shows it a little differently, but you can see U.S. is a net exporter on the far right, Eric, where it's minus 3%. But you can see that Japan, South Korea, and the Euro area, United Kingdom and China, are net importing. That gives the United States an unusual advantage. We are exporters of natural gas, a lot of natural gas. So you can see that the U.S., with our energy programs, are in very good condition. We're not dependent on bringing oil in from overseas. We have our own oil and gas. So this is a good sign for the U.S. economy. All right, oil shocks. This is how does it impact household consumer purchases? The real PC. This is what consumers are spending. And you can see historically, there's minimal risk if it's just a 10% shock and a short-lived. It's not a big deal. It's minimal risk. But if you go to the next slide, you can see how these increase largely, that it can impact consumer spending if it's a larger, more persistent shock. So this is kind of where the barbell is. Is it going to be longer or shorter? This is why this is really important, because it can begin to hit consumer spending if it begins to stay on too long. So this is a big if. And so we'll have to see how it unfolds, but there are more risks if this persists. Now, typically, who gets hurt the most in rising energy costs, especially gasoline and so on, and that's the bottom 10%. It's 14% of their spendable, their pre-tax income. And you can see how little it impacts the top 10%. But this is an interesting chart because the lower income will be impacted more because a higher percentage go towards gasoline and energy than the other groups. But you can see how that unfolds. So lower income consumers will be hit more if these oil prices stay high. However, the top 10% of U.S. earners account for 49, almost 50% of the spending is in the top 10%. The bottom 80%, Eric, 80% of U.S. consumers, top 80, the 80% is only 36% the count of consumer spending. So the people that aren't impacted by the higher oil prices are spending almost half. And that's an interesting stat. So
Yeah.
this does point towards the economy can continue to do well, even if this goes longer than most expect.
Yeah, because so much of our economy is consumer spending.
Right, correct. All right, but rising oil prices may impact inflation. This is a 1 year. You can see where the oil prices go and how the change and the CPI component of energy. And it's 6% of the CPI basket is energy, but you can see it's been low. But that shows there could be an uptick in the inflation rate. Now, this kind of goes back to the Federal Reserve. Are they going to lower rates? And this is what they're looking at. So we could see a temporary rise in the CPI because of the energy basket that could begin to go up and impact the inflation rate. And as a result, you can see the oil 5-year break-even, the dotted line or the yellow line is the 5-year break-even inflation rate expectation. That's been rising. And you can see, look at the number of cuts expected. It was around 2% not that long ago before the war. Now it's gone and dropped to the left column, less than 1%. Less than 1 is the expectation. On the left y-axis is showing just less than 1 chance of a probability of a rate cut. So it's come down dramatically because of this Iran war. Now, we think if this gets resolved quickly, we think that could turn around. But currently, right now, there's low expectation of the Fed cutting rates, which does put some pressure on stocks. All right, the U.S. scale, duration, and endgame. This is important. We don't know. Nobody knows. Of Iran, it's unknown. Now, this is an interesting chart. You can see the number of fired missiles by Iran. It's been declining significantly over this period of time, and it's going to continue to go down. And obviously, the goal in the United States and Israel is to bring that to 0. And if that happens, that will be good news for the stock market. Also, they use drones, one-way drones, and that's what's happened. It declined immediately, but you can see on 316 it bumped up. And then the last several days, we've seen a higher number. We're going to be monitoring this, but obviously the goal of the missiles and the drones is to go to 0. And when that happens, that will be good news for the stock market. So what's our outlook for 26? We haven't changed much, Eric. We expect extreme volatility, which is exactly what's happening as we unfold through here. We do expect the economy to stay resilient, no recession. Now, there's a caveat there, and that is that oil stays high for a long periods of time. The war keeps going much longer than most expect. That could have an impact on this forecast. And then we have deflation arise. We still think by the end of the year, we could be, if this war gets resolved, we could end up heading towards that 2% inflation rate. If Fed keeps cutting rate, well, right now they've stopped, but we think that labor will eventually cause them to cut rates again, because we think there will be some upcoming impact on labor. And of course, they have that dual mandate, Eric, of inflation and employment. So we think eventually that will be the reason they'll cut. And of course, if this gets resolved quickly, that will be better for everybody. We're still bullish on stocks. And we've said this, we see pullbacks, weaknesses, buying opportunity. That has not changed. We got the catalyst policy support, accommodative Fed. Well, that's kind of neutralized right now. So you could put a maybe on that. And then AI-driven productivity gains align. And then AI stocks, we still believe, we're starting to see that now. There's been a shift back to technology, and AI beneficiaries are starting to recover. And we think that they will begin to dominate as we go forward. And we could see a couple rotations in this year where growth and tech come back, and then later in the year they could end up underperforming. So we're going to be watching that, and we may be making some trades to accommodate that. So we still think a 10 to 15% return by year end. And we've had this in here a while, the wild card. And of course, two of them have triggered: the Middle East escalation and commodity energy shock. Those two are there. So how long this lasts, how long the duration, what's the end game of the Iran war will determine whether or not all this comes to pass. We're still in the camp of being bullish to the year end. But there will be extreme volatility, and we do expect that there could be. You look at our anticipate correction intra-year. We haven't had that yet, but we still expect that as a possibility, and may be on the way now if things don't turn around soon. But we would look at a correction as a buying opportunity, and what we want to avoid, and where we may raise cash if we see a bear market. Now, that's expectation of a 20% drop in the market. We don't try to time 10% drops or corrections because there's too many of them. They move quickly. They don't last long. But if we did think a bear market would be approaching, then we would begin to potentially sell some stocks and raise some cash. That's not where we are today. But we're going to be monitoring the Iran war and oil prices as we go forward.
Very good. Thank you, Tom. Appreciate your analysis, the positives and the negatives as always. That very objective approach. We appreciate that a lot. Been watching my email, been watching our texts. Don't see any questions at this time. So friendly reminder, if you have any questions, we would love to field those. If you are with us here live, I do see that there's a good handful of you guys out there. So thank you. If you're watching in the recording, you're also invited to post any questions, email, text us at our office number. I would love the opportunity to circle back with you on any of those. I will, a couple things here, as those of you who may be contemplating posting a question, you got another minute or so. I will have the recording to this message on our website here this afternoon sometime. So you're invited to go back if there's any areas that you wanted to review of what Tom was talking about. That'll be up there for you. You're also invited to post a question if you want to do it more privately. You can do that right there with that Ask a Question button. And I'll also have a nice, convenient 2-page summary for those of you that would like to review that. So that should be up on the website this afternoon sometime. And then also reminder, if you'd like to touch base a little bit more often, I do start my week out every Monday morning, 9 a.m. Central, with a more brief kind of recap of what's going on, maybe sometimes some things that are happening around the office or things that we're watching for. And again, that's on our website and the different social media pages as well. And then at 2 p.m. Central, I send out an email with even more information. So if you're not getting that email, you can subscribe to it at our website, of course. Our next monthly update is penciled in for Thursday, April 16th. So right after tax day. So we'll be looking forward to Tom's update at that point. Who knows? Lots can change. Tom, you've been talking about volatility since December. It's here. It's been here. Sounds like we're going to keep watching for that. So I look forward to that update as well. But hopefully we'll have this Iran stuff behind us by then. We will see. So with that, I'll take one more look at email, text. I don't see any additional questions. Let me check online. Don't see anything there. So we'll move forward here, Tom. Any closing thoughts you'd like to leave us with?
Yeah, just that we are monitoring this war and the expectation and duration. We still think there'll be a potential for a positive outcome. And of course, how long that takes, will determine how it impacts the economy or even stock prices. So it's still too early to know. In fact, nobody knows, but we are monitoring it, and we will make adjustments if we see something that does not, if it doesn't unfold like we think it could be unfolding. So we're watching it for you. And if we see something that is outside of our forecast right now, we will make adjustments. So we're there for you.
I appreciate that. That's a very good reminder. Sometimes when we have the volatility like we've had, I've had a few calls on this point exactly, that you feel all this volatility, you see it happening out there, you see the headlines on the news media, and it feels like maybe it's worse than it actually is. And a few calls, hey, what's going on? The markets are, correcting, and we were actually only down about 3%. So it can feel a lot worse than it actually is. So it's important to keep that objective view on everything that's going on. So we appreciate you for that, Tom. And with that, I will wrap us up. No questions came in. So if you're watching in the recording, or if you think of something later, do not hesitate. We would love the opportunity to circle back with you. But with that, thank you all for joining us here today. We do appreciate you taking the time. That concludes this month's Capital Markets Update and Outlook call for March. Everybody have a wonderful rest of your week. Bye now.
Thank you, Eric.
Thank you, Tom.